Hey again, and welcome to this video. In this video, we're going to go briefly into real estate considerations pertaining to operating businesses. We're going to touch on a concept called a sale and leaseback, which is one of the many ways a business can tap into alternate sources of funding when it's having difficulty raising more debt or obtaining investor funding. We'll be going also through certain considerations, certain concepts, certain formulas, as well as key insights depending on whether you are sitting on the seller's side of the table or the buyer's side of the table in a sale and leaseback transaction. I think this video is going to provide value to you, especially if you own a business that also owns the real estate in which it operates in. So let's start by looking at the process overview of a sale and leaseback. A sale and leaseback is a fairly easy concept. It is in line with what the name says. By sale, you sell, and by leaseback, you lease something that you just sold back again. The first step in a sale and leaseback is, in the context of a company that owns its real estate assets, such as warehouses or office buildings, is that they need to have decided to sell those assets as a way to free up the capital that is locked in these hard assets and then lease them back from the new owner. So they will continue to operate in these facilities. However, rather than be an owner of these facilities, they will be a lessee of these facilities. And a typical reason for this structure is to release cash that is stuck in real estate assets and to use those proceeds for a specific purpose, such as funding growth or settling maturing debts. And I'm sure you've heard the idea of asset-light versus asset-heavy businesses. The idea is asset-light businesses, those businesses that do not have a lot of their cash stuck in hard assets, are considered to be more agile. The second step in a sale and leaseback is the same business that sold the real estate will enter into a lease agreement with the new owner or the new investor of that real estate asset to lease back that asset that they just sold and continue operating the business in it. Among other things, the lease agreement will specify obviously the terms of the lease, so the rental amounts, the duration of the lease, the increases, each party's responsibilities, which we will get to in a bit, depending on the nature of the lease, if it's a triple net lease or not. And the last step, which is not really like part of the process, but it's just as an option, is that they can include options as part of this deal. So let's say the seller that owns the real estate needs cash, but is worried that if they sell the real estate, they might never be able to get it back again. What they could do to overcome such resistance is to negotiate with the new investor a call option. After, say, a few years, whereby the seller today will have the option to buy back the real estate that they just sold to the new investor due to a cash shortage so that they can get it back. And what they could negotiate as part of the deal documentation is the terms for such a buyback. So they could define the pricing mechanisms, whereby, say, when the call option vests in, say, year 5, the way they price the deal, should the seller today opt to exercise that option and say, yes, I'd like to buy back that real estate that I sold 5 years ago because I no longer have cash flow problems today, the pricing at which that deal is done could be predetermined at the time of signing the sale and leaseback. One example of such pricing is, say, whatever the rent is in year 5, per the lease agreement, we will just apply a cap rate on that rent. So let's say rent in year 5 is $10 million, hypothetically. We will apply a cap rate of 8% on that $10 million, which means that, or which implies that, at a $10 million rental amount divided by a 8% cap rate, the value of the real estate in year 5 is $125 million. And so should the seller today wish to exercise that option in 5 years' time, they know in advance that they need to procure or come up with $125 million to buy back that asset. Another important point here is they could also include a right of first refusal as part of the deal documentation. And what does that entail? It is simply assurance that is given to the party that is selling the real estate today that if the new investor wants to sell that real estate that they acquired, before they do so and sell it to a third party, they have an obligation to come back to the seller today and tell them, this is the deal that we have. We are considering this deal seriously. If you are able to match this deal, then it's yours. You have the right of first refusal. And only if you choose not to pursue the deal will we sell to that third party. So that's another example of how creative these deals can get. So let's look at the key considerations within the commercial real estate space, just so that we can give you a taste of what are the most prevalent themes in that space. So the first one is something we call a triple net lease. And the triple net lease is an agreement whereby the tenant, not the landlord, has to pay all the expenses associated with the leased property. Okay, and these expenses are not just rent and utilities and fit outs. All the expenses include taxes, servicing, maintenance, insurance, etc. So a triple net lease is one whereby the tenant is responsible for all expenses pertaining to the property. A single net lease is a lease whereby the tenant pays, in addition to rent and utilities, property taxes. A double net lease is one where the tenant pays property taxes and insurance premiums pertaining to the rented property over and above the base rent and utilities. And the triple net lease, again, is one where they pay everything, most notably property taxes, insurance, maintenance costs, rent, utilities, etc. The second concept we want to discuss is something called the rent coverage ratio. So if you were to put yourself in the position of the buyer or the investor of a commercial real estate property, you are effectively taking a position on the credit worthiness on the entity that is selling you its real estate, especially if it's in trouble and the reason it is selling you its real estate is so that it could raise funds because it's unable to raise funds from the bank or from investors. In that case, you want to make sure that they are generating enough cash to cover their rent, or else they are in default. So the rent coverage ratio is the ratio of the tenant's EBITDA, that's the earnings before interest, taxes, depreciation, amortization, and rent, to the tenant's annual rent. And the EBITDA is the EBITDA before they sell the real estate assets. So whatever their EBITDA is today, before the deal, becomes their EBITDA after the deal, which is the amount they have to cover the rent expense. But as a rule of thumb, the higher that ratio, the higher your numerator in that equation over your rent expense, the better the tenant's credit rating, or the better their credit worthiness. The more worthy they are, and the less likely they are to default on their rental payments. Sometimes that formula is presented in the other way around, whereby rent is calculated as a percentage of EBITDA or revenue. And what usually happens is that percentage is obtained from the market and then benchmarked against the company that you're looking to do a deal with. So for example, if on average rent constitutes 8% of a company's revenues, however, for your company that you're looking to do a deal with, that ratio would look at 15%. That means that you've got a little problem, because your numerator, which is rent in this case now, is much higher versus your denominator, which is EBITDA or revenue, which means that it's going to put a bigger strain on the business as an expense. So in such cases, the lower the percentage, the better the tenant's credit worthiness, and the more likely they are to cover their rent. And oftentimes, these percentages are compared against other market players just to get an indication of what the norm is. LTV, or loan to value, is another concept that is calculated by lenders mostly, banks typically, by dividing a loan amount you are looking to get from them by the property's valuation. And the easiest example here is in residential real estate. So in residential real estate, the norm is, in order to obtain a mortgage to acquire or to purchase a house, you need to put 20% in equity. You need to put 20% of the value of the house in equity. And the bank would fund 80%. That 80% is the loan to the value of the house. And the same concept applies in commercial real estate. A lower LTV, a lower loan to value, means that there is less debt being issued relative to the value of the underlying assets, which means that if there's less debt relative to the value of the asset, the lender is taking less risk. And if they're taking less risk, that means that usually, assuming all else equal, a lower interest rate applies. However, if the risk becomes higher and the borrower is asking for a higher LTV position, then the interest rate will reflect the higher risk, so it will be higher. Generally, commercial lenders for commercial real estate resist exceeding an LTV, a loan to value, of 65% when financing real estate acquisitions. Obviously, there are exceptions to the rule, but this is usually the consensus. The other concept now that we want to discuss is what shell and core means, because this is also a common commercial real estate term. And what this refers to, what shell and core refers to, is the first phase of a commercial real estate project. So when you acquire a property that is considered shell and core, you are acquiring a property where the inside of the facility, or the core, and the outer building are completed, but without fit-outs or ceilings. I know it sounds a little alien, but there are many reasons why this is a good idea for tenants as well as landlords, including but not limited to added flexibility, speed of delivery. You don't have to wait for a developer to complete the fit-outs. Cost effectiveness. You, as a tenant, are in a better position to design based on your specs and your requirements, and you can customize space depending on your needs. The core includes the staircases, the elevator shafts, as well as mechanical devices and wiring. The shell, on the other hand, pertains to the exterior features. So the shell pertains to the structural skeleton of a building, its foundation, external walls. The shell of a commercial property protects the core elements of it. And these are usually done early on in the construction process. The next concept, or the next idea, is distinguishing between a freehold property and a leasehold property, whereby a freehold property means you own the land and the property on which it's built. A leasehold property, however, is one that is owned for a fixed period of time, but the land on which the property is built is not yours. That is something that investors obviously take into account. The next idea is payment in arrears versus advance payment. This is relatively straightforward. Advance arrangement payments are those whereby lease payments are due and payable at the beginning of each payment period during the lease term. However, payment in arrears, lease payments are due and payable at the end of each payment period during the lease term. And yes, those exist. Payment in arrears exist depending on the nature of the deal. But the key point here is that when an investor is calculating returns on a particular transaction, rent in advance versus rent in arrears makes a difference in the returns. Because obviously, if you are collecting rent in advance, let's say you get rent for 6 months in advance, or a year in advance, or every month you're getting paid as soon as the month starts, this is going to help your returns versus when you collect rent at the end of a certain period. The next concept is the right of first refusal, the ROFR. This is something we discussed earlier. It describes the legal right given to a party to be the first to submit an offer on a specific property. In the event that the holder of that right does not want to submit a legally binding offer to acquire the property, the seller may then accept other offers from other buyers on the market. Next is valuation. So although there are multiple ways to value commercial real estate, I'm going to be discussing two common methodologies in this video. The first one is called the replacement cost approach. The second methodology is called the gross rent multiplier approach. The replacement cost methodology, as the name indicates, is a calculation of what would it cost to replace a certain property in its existing shape and form. And so it entails using current construction techniques and materials to create a structure with the same quality and utility as the existing structure. So it's not replacing it with a brand new facility. Its formula is value of the land plus the cost to build minus depreciation. And the depreciation is simply a calculation to ensure that the comparison is apples to apples. So the replacement cost for a 20-year-old facility should reflect the depreciation of a 20-year-old facility. So the relevance of depreciation here is to ensure costs are reflective of properties in similar conditions. And the idea here is that buyers are unlikely to pay more for a property than what it would cost to build a similar structure. But this is one of the methodologies that investors look at. The second method is called the gross income multiplier method. It relies on market data to determine a property's value. So it's like a relative valuation method. So let's say an investor is interested in acquiring a certain commercial tower. What they would do using this technique is they would look at recent property sales in a given area to gather more information. So let's say a similar commercial tower recently sold for $5 million and that its gross rental income was $888,000 per annum. Then its gross income multiplier is determined by dividing that value, 5 million, by 888,000 to get 5.63x. This 5.63x is a multiple that could be applied on a similar property in order to get its valuation. So let's say that in order to get the valuation on that 150,000 square foot commercial tower, two things are needed. How much this tower would be able to generate in gross income per annum, and that 5.63x multiple. And we'd multiply the two together in order to get the valuation. Now you might tell me that how will I know what the gross income for that commercial tower is if I do not have access to the data? And that's a great question. And the answer is the best you could do in this case is try to get comparable metrics from the market per square foot. So let's say in a certain location, a square foot of commercial real estate is being rented out per annum for $10 per square foot. You can then multiply $10 by the square footage of this commercial tower. What you could also do is assume a vacancy rate. So let's say you're going to assume that no commercial tower is 100% occupied by tenants. So let's assume a vacancy rate of 50%. You can then apply that 50% on that gross rental figure that you got, and then multiply it by the 5.63x multiple in order to get the implicit valuation. One thing to note also here is that the gross rental income is Gross. Gross means that it's before taxes, before insurance, before utilities, before any other expenses associated with the property that are borne by the landlord. Next to discuss is the capitalization rate, or the cap rate. The cap rate represents a property's real market return without using debt to finance its acquisition. And I'll explain that in a minute. It is as if you are assuming that if you acquire a tower, say, entirely with cash, what is the net return you will get on your investment? So the formula for calculating the cap rate is net operating income divided by the current market value of the asset, whereby the net operating income is equal to the annual income generated by the property after deducting all related expenses. So let's look at the illustration below for more detail. Let's say the first commercial property is a hospital building with land. And let's say that its market value is $53.2 million. And that the annual rent this property is able to command is $4.3 million, $4.4 million a year. And that the total expenses that the landlord is responsible for paying are $1.6 million a year. Which means that from the landlord's perspective, their net operating income is whatever they collect in rent, less whatever they pay in expenses. And the cap rate as an investor, from an investor's viewpoint, is that net operating income of $2.8 million a year divided by $53.2 million a year, that's 5.3%. One thing to note here is that, generally speaking, a high cap rate could imply a higher risk profile for a particular commercial real estate asset, which means the building could be in bad shape. It could require a lot of investment, capital expenditure, a lot of maintenance, a lot of upkeep. It could also mean that the location is not great. A low cap rate usually means that risk is lower. Risk could be related to location, the type of property, demographics, property condition, the catchment area itself, if it's a growing, bustling location, or if it's an area that is losing residents. So it really depends. But the key idea here is that there is no cap rate that is considered optimal for all investors alike. It really depends on each investor's risk preferences. Now that we've gone through certain commercial real estate ideas and concepts, I want to take you back to the sale and leaseback transaction that we discussed earlier on in this video. And I want to do a side-by-side comparison. So if you are a seller of real estate and you are looking to lease back that real estate that you are selling, naturally you want to lease it back at a competitive rate. So a competitive rental rate is offered, and expenses such as basic maintenance, service fees, property taxes, and insurance should move, or you'd want them to be borne by the new landlord. You don't want to keep paying these expenses. You want to shift these costs away from you and make some savings on that. If you are the investor of real estate, you would want the rental yield to be as high as possible. You want to make a return on your money. And naturally, you would want the tenant to take care of everything. So you would want to push a triple net lease in this case. The next consideration is, if you are selling your real estate, then the new incoming investor that is looking to buy the real estate from you needs to be easy to work with and respectable, because they are effectively going to be your new landlord at the property that you've owned. So this is going to be a new element. This is going to be a new dynamic that comes into your operations that is going to frustrate you. You're going to be liable to pay rent in accordance with the lease agreement, and you're going to be required to liaise with this new investor, who's now your landlord, on a continuous basis. So there needs to be proper collaboration between the original seller and the new landlord during the lease period. Also, you would need to have a very transparent relationship. You need to agree as to when rent is paid, what are the increments, what are the lease terms. So you need to really have a collaborative relationship, especially when you're negotiating these documents, the deal documents. From the perspective of the investor of real estate assets, they want to know that the tenant or the existing seller of the real estate properties is creditworthy and that their business is healthy and thriving. Why? Because if the business is doing okay, they're going to be able to pay rent. If the business is not doing okay, they're going to not pay rent. And that's a key consideration. One way to provide added assurance to the acquirer in the event that the existing seller is not perceived to be creditworthy is to provide a corporate guarantee or a personal guarantee. This is a common thing to happen in deals of such nature. The next point is, if you are selling your real estate in a sale and leaseback deal, you want to make sure that you sell it at an attractive price, because that would give you the opportunity to use all the proceeds from the sale for their intended purpose. Let's say, for example, that you sell a property for $6.5 million, but its value is 5.5. You may be able to justify a higher valuation, that's 6.5 million, if you give the buyer a higher yield than what the market is paying, and for a long period. So let's say that the market yield is on average 8% of the property value. If you pay 9% of what the property value is, but can get a higher amount up front, and let's say the reason you want that higher amount up front is so that you can settle maturing debts that if you don't settle could have an impact on your business operations, and that could be something that could be discussed and negotiated. If you are the acquirer, if you are the investor, obviously it's the other way around. You want to be able to get a good deal. You want to pay 4.5 million for an asset that's worth 6.5 million. The key insight here is that commercial real estate deals are not hunted or are not on the radar of too many investors, especially if the transaction size is not very big, because big deals are obviously on the radars of big institutional investors. But deals that are generally smaller are below the radar. And so the pool of buyers available for such deals, especially relative to the big commercial real estate deals or residential market, tends to be smaller, which means that you can get good bargains. The next point is, if you are a seller of the real estate in a sale and leaseback, you want the transaction costs related to the deal, such as the transfer and registration fees, to be borne by the buyer. And if they disagree, obviously, at least to be divided equally. You don't want to pay for the registration and transfer fees. On the other side of the table, if you are the acquirer of the real estate, you want the transaction costs related to the sale and leaseback, such as the transfer fees from the existing seller to you, the registration fees, you want them to be borne by the seller. Ideally, that's what you want to happen. And if the seller is really pushing back because they claim they're distressed and the reason they're doing this deal in the first place is so that they could raise money, then you can then accept for it to be divided equally, or in extreme cases, if the deal is still attractive, you can bear that cost. The next point to discuss is the exit options for both the seller today of the real estate assets and the new buyer of the real estate assets. So from the seller's perspective, they would want to negotiate an exit option with the buyer, with the incoming buyer, whereby if they want to buy back the property they are selling today, once their financial situation is better, then they could do so. And that is called a call option. So for example, let's say that the buyer and the seller agree at the time of the sale to a call option in favor of the seller after 7 years of the lease term that is valid for a period of 12 months at a valuation based on the 12-month forward rent in 7 years divided by a certain cap rate. So let's say hypothetically it's 7.85%. So what would happen? In year 7, that option becomes exercisable, and it becomes exercisable for a 12-month period. So the seller in that duration, in that window of opportunity, can choose to exercise that call option and buy back the real estate they sold today at a valuation of whatever the rent is 12 months forward from when they exercise that option, divided by the 7.85% exit cap. That's it. That's it. They already know in advance, if they want to buy back that property, what it's going to cost them. On the other side of the table, the incoming buyer of the real estate might also want to exit that asset, and they could agree to a put option with the existing seller, whereby, let's say after 8 years, not 7, of the lease, and for a period of 12 months, they can choose to exercise that option, whereby the seller has to buy it back from them at a valuation based on the 12-month forward rent divided by a 7.85% exit cap rate. This gives flexibility and it de-risks the transaction for both buyer and seller when they have such options for exiting. The next point that I want to discuss is not exactly like for like. So point 18, what is point 18 saying? It's saying that the release of capital trapped in real estate is used to bolster the growth and profitability of the business, particularly if the benefits from selling the property and reinvesting the proceeds outweigh the rental savings from owning the property. This is obviously from the perspective of the seller of real estate who is contemplating the sale and is resistant to the sale. And the idea here is that if unlocking that cash that is trapped in real estate assets that has nothing to do with your day-to-day operations, if unlocking that cash and using it for a more urgent or important or more lucrative alternative, then it might make sense. You don't need to hold on to that property, especially if you could negotiate a call option back. That's a key consideration for the seller. Another key consideration for the buyer is that obviously the location, the condition of the property, the market demographics need to be outstanding for the asset they are looking to invest in. The last thing they would want is to be stuck in an area that is losing residents, that is losing footfall, that nobody has an interest in renting without any exit options. That would be a bad deal for them. The last 2 points we're going to be discussing is that upon mutual consent of both the existing seller and the incoming buyer, they could agree for a long-term lease or a lease to be extended for a longer period, subject to mutual consent of both parties. If everything is going great between the landlord and the tenant, and both are acting in accordance with the executed deals, then they both might want to renew the lease agreement. And that is something that could be agreed to in the documentation. The last and final and probably most important point is that both the seller of the real estate and the incoming buyer enjoy working together, because deals of this nature require long-term commitment and continuous communication. When the relationship is transparent, functional, and collaborative, it could be a win-win. It should not be a zero-sum game. The second it starts becoming a zero-sum game is when things start becoming tense and potential litigation issues might arise. So this is a very important point, probably more important than the valuation. Only do business with those you enjoy doing business with and those who act with transparency and integrity. So that was it. That was commercial real estate within a sale and leaseback context in a nutshell. Please download that file, use it as a reference if you want to, and I hope you found this video valuable.